Don't let hope become a financial death sentence. Today I want to speak plainly. There are 5 assets you must own before retirement. Not nice to have, not optional, but must have. If your goal is a secure, comfortable retirement built on confidence rather than fear, then these 5 asset categories must be present in your portfolio. And this is the problem I have seen repeatedly over decades in the markets, from post-war booms to devastating crashes like the Great Depression or 2008. Most people approach retirement backwards. They work 40 years, save whatever they can, then simply hope it's enough. No real structure, no clear plan, no deliberate asset strategy, just blind optimism. But hope is not a strategy. I have watched it fail time and time again, leaving good people struggling in their final years. Because when you reach 65 and discover the numbers don't add up, there is no do-over, time has run out, you have lost the most valuable resource. Retirement planning depends entirely on the power of compounding over time, the very principle I have relied on throughout my investing life, much like the patient approach at Berkshire Hathaway. At that point, fixing the problem becomes painful and difficult, often requiring sacrifices no one foresaw. Lately, I have been thinking a great deal about retirement, not my own. I am 94 and have no intention of retiring. I am talking about the retirement system itself, how people plan for it, how they fund it, what they get right and what they consistently get wrong. Lessons drawn from decades of observing human behavior in finance. And I am not talking about hedge funds, complex derivatives, or strategies that demand constant monitoring. These are simple, time-tested assets that have endured for decades, standing firm through high inflation and economic downturns. They perform 3 core jobs. They generate income, they protect purchasing power, they provide stability amid unpredictable markets. Let us begin with the most important and first asset, the eternal money printing machines and the massive savings account, a diversified portfolio of high-quality dividend growth stocks. This is the true foundation for retirement income. Not bonds, not annuities, but dividend-paying stocks from companies with decades-long track records of steadily increasing their payouts. Here is why this matters so profoundly. When you retire, your paycheck disappears forever. You need reliable real income you can count on year after year without wondering if the well will run dry. There are only 2 ways to fund your retirement lifestyle. From investments, you either sell shares, gradually shrinking your principal over time, or you collect cash flow generated by the assets you own without ever touching the principal itself. If you rely on selling shares, you are living on a ticking countdown clock. Market drops become terrifying because they accelerate the depletion. And if you live longer than the averages predict, which many people do, you risk outliving your money completely. Dividend growth stocks solve this problem in a completely different way. With the right companies, those dividends can continue indefinitely. You simply hold the shares, and strong, enduring businesses send you cash every quarter reliably and predictably. Even better, when those dividends increase over time, your income rises naturally with them. This is why quality is everything. You are not chasing the highest yield at any cost. You are seeking stable, high-quality businesses with durable competitive advantages, strong balance sheets, and a proven history of raising payouts year after year. Think of companies with powerful brands, consistent earnings power, and shareholder-friendly management. Businesses that have raised dividends for 2, 5, 5, 0, even 60 consecutive years. Names like Coca-Cola, Johnson & Johnson, Procter & Gamble, and McDonald's come to mind. Boring, yes. Stable, absolutely. Consistent, without question. That is precisely what you want when your financial security no longer depends on a salary. Now consider the mathematics, which I have watched compound over many decades. Suppose you retire with $1 million invested in a diversified portfolio of dividend growth stocks yielding an average of 3%. That delivers $30,000 a year in income right from the start. On its own, that may not feel like enough, but the real power is not in the initial yield. It is in the growth rate of those dividends. If the companies increase their dividends at an average of 7% annually, a realistic figure for quality names, the income transforms dramatically. After 5 years, you are collecting around $42,000. After 10 years, roughly $59,000. After 20 years, well over $100,000 per year. And this growth often outpaces real inflation because the underlying businesses grow earnings and raise payouts accordingly. Meanwhile, Social Security adjustments frequently lag behind true cost of living increases. Here is the overlooked benefit that changes everything. You did not sell a single share to generate that rising income. Your principal remains fully invested, continues to grow in value, and can one day pass to your family intact. The dividends come from productive companies doing real business in the world, not from withdrawing your own capital. Throughout most of my adult life, I've relied heavily on this kind of dividend income from businesses I own. While Berkshire Hathaway itself does not pay a dividend, I have held and still hold many exceptional companies that do. Year after year, I have observed that dividend income from strong, profitable enterprises is among the most dependable and resilient income streams ever created. So, before you retire, build a diversified portfolio of high-quality dividend growth stocks. Not just 2 or 3 names, but 10, 15, even 20 solid companies across different industries, chosen for durability rather than excitement. Plan to hold them forever. That becomes your primary retirement income engine, quiet, powerful, and built to last. The silent treasure, the magical power of time and compounding, a low-cost S&P 500 index fund you do not touch. People often ask, if dividend growth stocks are already the income engine, why do you also need an S&P 500 index fund? The answer is simple yet profound.
You need both roles covered. Dividend stocks give you cash flow to live on today. But retirement faces many risks: inflation spikes, unexpected medical costs, market volatility, or simply living much longer than expected.
You need a separate pool designed to grow quietly in the background, an asset you tap only if truly needed. That is what a low-cost S&P 500 index fund does. It gives broad exposure to 500 of America's largest businesses. No individual stock picks. No, timing the market. You own the productive core of the U.S. economy over long periods, 20 or 30 years or more. It has historically delivered strong returns, and it is simple. Buy it, hold it, let time do the work. No constant decisions, no headline chasing. Think of it this way. Your dividend portfolio is like your checking account. You live off the dividends. The index fund is your savings account. You protect it fiercely and touch it only in real emergencies. For example, imagine retiring with $700,000 in dividend growth stocks and $300,000 in an S&P 500 index fund. The dividends cover ongoing income. The index fund compounds quietly over 20 years at long-term historical returns. That $300,000 can potentially grow into something far larger, possibly $1 million or more, while your dividend holdings keep paying you the whole time. The result is a portfolio built for real-life income to live on now, growth to protect the future, a buffer for emergencies, and a structure that survives bad years in one part. So before retirement, build a low-cost S&P 500 index fund position and commit to leaving it untouched except in genuine emergencies. This is the silent treasure that harnesses the magical power of time and compounding. The force I have seen turn modest sums into life-changing wealth for patient investors across decades of market ups and downs. The real estate shield and the art of defending against the silent enemy of inflation, income-producing real estate, or REITs. REITs are pronounced REITs. They stand for Real Estate Investment Trust. The third essential asset you need before retirement is real estate that generates stable rental income. And I must be clear here. I am not talking about your primary home. Your residence is not an investment asset in this portfolio sense. It is a lifestyle choice, often a wonderful one, but it is also an ongoing expense. It may increase in value over time, but it does not send you monthly checks. It costs you property taxes, insurance, maintenance, repairs, and opportunity costs. What truly matters for retirement security is cash flow real estate. Rental properties, whether apartment buildings, single-family homes, small commercial spaces, or even farmland in some cases, must deliver positive net monthly income after all expenses. The reason this is so powerful is simple and has been proven over time. Rental income tends to be extremely stable. People and businesses always need places to live and work, no matter how the stock market fluctuates. More importantly, rents often rise with inflation, and in good locations they can even outpace it. When the cost of living increases, landlords can raise rents to maintain real purchasing power. This automatic inflation protection mechanism is one of the reasons real estate has become a foundation for preserving wealth over centuries. Real estate also provides true diversification for your retirement plan. It is not perfectly correlated with the stock market. During stock market crashes or bear markets, tenants usually continue paying rent as long as they have jobs or businesses operating. The cash flow keeps coming even when Wall Street is in chaos. That stability becomes priceless when you no longer have a monthly salary and every dollar counts. Of course, owning real estate directly is not easy. There are management hassles, tenant problems, vacancy periods, unexpected repairs, and local regulations. Not every property is a good deal, and poor choices can turn into burdens. But when done carefully, with good locations, reasonable leverage, and professional management, rental real estate has proven to be one of the most reliable paths to building long-term wealth and income. If you want to avoid the hands-on work of being a landlord, real estate investment trusts or REITs are an excellent option. REITs are companies that own, operate, and manage large portfolios of income-producing properties. By law, they must distribute the majority of their taxable income as dividends to shareholders. You gain broad exposure to real estate sectors, retail, office, industrial, residential, healthcare, data centers, without worrying about plumbing tenants or termites. Many high-quality REITs have consistently increased their dividends for decades, providing both income and some inflation protection. No matter which path you choose, direct ownership or REITs, the goal remains the same. You need meaningful exposure to income-producing real estate in your retirement portfolio. It adds a layer of stability that stocks alone cannot provide, and it helps ensure your purchasing power is not eroded over a long retirement. Therefore, asset number 3 is essential. Make sure you have income-producing real estate or high-quality REITs before you retire. This is the shield that keeps paying you while the world around it changes, a time-tested defense against the silent thief called inflation, something I have seen protect many families through decades of high inflation and market volatility. Don't let the silent thief erode your entire retirement inflation-protected government securities, TIPS, or I bonds. The 4th essential asset is specifically designed to handle one of the most underestimated threats to retirees, inflation. Traditional bonds are often presented as safe. Many people hear retirement and immediately think conservative, so they move heavily into bonds or fixed income products.
That instinct is understandable, but it is outdated and can be quietly destructive in an inflationary environment. Fixed payments stay the same while prices around you keep rising.
Your purchasing power gets eroded year after year, often without you noticing, until it's too late. Treasury inflation-protected securities, or TIPS, work differently. Their principal adjusts automatically with inflation measured by the Consumer Price Index. If inflation rises 3%, the principal increases by about 3%, and you earn interest on that higher adjusted amount. I bonds work on a similar principle, offering direct inflation protection for individual investors. The goal is simple: protect your purchasing power so the money set aside for retirement still buys roughly the same amount of goods and services decades later. Why does this matter so much? Inflation slowly ruins fixed income retirement plans more than most realize. If you retire with $50,000 a year in income and inflation runs at 4% annually for a decade, your $50,000 starts feeling like roughly $33,000 in today's buying power. That difference can turn a comfortable retirement into one filled with stress and cutbacks on travel, healthcare, or basic living expenses. TIPS and I bonds provide defensive stability. They are not your main growth engine. Stocks and real estate generally outpace inflation long term. But a practical allocation, perhaps 10 to 20%, depending on your situation, is enough to act as insurance against the worst inflation surprises. It gives you peace of mind that at least part of your money is shielded from the silent thief that has quietly destroyed so many retirements.
Think of your portfolio this way. Stocks and real estate are your offense, driving growth and income. TIPS and I bonds are your defense, the quiet safeguard that keeps erosion at bay when everything else is under pressure.
Therefore, asset number 4 is crucial. Include Treasury inflation-protected securities, or I bonds, in your retirement plan before you retire. This is the built-in inflation defense that protects your lifestyle when headlines scream about rising prices. A lesson I have seen play out painfully for too many people across the inflationary cycles I have lived through. Don't let debt on your home become a burden in your final years. A paid-off home or very low housing costs. The 5th asset surprises some people, especially since I said earlier that your primary home is not an investment. That remains true. Your home is not part of the income-producing portfolio. But a paid-off home is one of the smartest financial positions you can carry into retirement. Not because it grows dramatically in value, but because it dramatically reduces your largest ongoing expense. Housing is usually the biggest cost in retirement. If you are paying $2,000 a month in rent or mortgage, that is $24,000 a year. Over 20 years, it adds up to nearly $500,000. If you own your home outright, your housing costs drop to property taxes, insurance, and maintenance, perhaps $6,000 to $8,000 a year instead of $24,000. That difference changes everything. It lowers the amount of income you need every month. It reduces stress during market downturns. It creates real flexibility for medical expenses, emergencies, or helping family. So if you are approaching retirement with a mortgage still hanging over you, paying it off should be a serious priority. Not the new car, not the kitchen remodel, not the vacation, the mortgage first. Yes, the math sometimes says investing the money beats paying off a low-interest loan. But retirement is not purely a math equation. It is about security, peace of mind, knowing you have a place to live that cannot be taken away because a monthly payment became unmanageable. If you are younger, the strategy is straightforward. Buy less house than you can afford, choose a shorter mortgage term if possible, pay it down aggressively, aim to have it paid off by age 60 or earlier if you can. So the final years before retirement are spent building the other assets, not draining cash flow to a mortgage. If you are older and the mortgage is still large, you have a decision to make. Pay it down with urgency, work a few extra years if needed, or plan to downsize and eliminate the payment entirely. What you cannot do is retire with a large mortgage and hope it works out.
Retiring with a big monthly housing payment is one of the easiest ways to turn retirement into constant financial pressure from day one. Asset number 5 is therefore vital.
Achieve a paid-off home or very low housing costs before you retire. This one change makes the entire retirement plan far easier to sustain. Lower baseline expenses, more breathing room, and true peace of mind in the years when income is fixed and life is unpredictable. It is a quiet but powerful foundation I have seen provide dignity and freedom to many people in their later years. 5 secret weapons that protect your retirement from every storm. Let us quickly recap the 5 essential retirement assets. Dividend growth stocks, your primary income engine that grows over time. S&P 500, index fund, long-term growth and backup capital. Income-producing real estate, or REITs, stable cash flow that often rises with inflation. TIPS or I bonds, inflation protection and defensive stability. A paid-off home, lower expenses and greater flexibility. These 5 assets work together beautifully because each one protects you from a different risk. When markets crash, your real estate income and inflation-protected securities stay relatively stable. When inflation surges, your dividend-paying companies and rental income can adjust upward over time. When you live longer than expected, your index fund keeps compounding quietly in the background. When unexpected expenses hit, your paid-off home keeps your baseline costs low and gives you room to breathe. This is not hope, this is structure.
It is a retirement built on real confidence, rooted in assets that have proven themselves over decades through wars, recessions, inflationary periods, and market booms alike.
Once you have these 5 in place, your retirement no longer depends on luck. It becomes calm, predictable, and resilient. No single economic storm can derail the entire plan. That is the power of this simple framework. A power I have watched deliver peace and independence to countless people over my very long life. The race against time and the power of decisive action. Now, we have covered the 5 assets. Knowing what to own is only half the equation. The other half is knowing what not to do, because I have seen people with decent savings still fail at retirement due to avoidable mistakes. Let me walk you through the most common ones. Mistake 1, putting too much money into bonds. Many hear retirement and think conservative, so they shift heavily into bonds. That feels safe, but it is outdated. Bonds do not grow meaningfully over long periods, and they perform poorly when inflation rises. In inflationary times, they quietly confiscate purchasing power. You get interest, but that interest buys less and less. Retirement can last 25 or 30 years, sometimes longer. A portfolio that does not grow is not conservative. It is fragile. Mistake 2, not owning enough income-producing assets. Some retire with a large portfolio, $1 million or more, but it is all in growth stocks that pay no dividends. Then retirement begins and the question hits hard, how do I live? The answer is usually sell shares. You are no longer living on what your assets produce. You are living on the assets themselves. Every withdrawal shrinks the portfolio. One bad market year early on can cause permanent damage. Mistake 3, retiring with a mortgage. This cannot be overstated. A mortgage payment in retirement dramatically raises the income you need every year and increases your exposure to market risk. Your portfolio has to work harder just to cover fixed housing costs. That forces riskier behavior at the stage when flexibility matters most. The solution is straightforward, even if not easy. Pay off the house first, then retire. A few extra years of work often buy decades of peace of mind. Mistake 4, lack of diversification. Some put everything into stocks. Others go all in on real estate. A few park nearly everything in safe assets. All these approaches share the same flaw concentration. Different assets perform well under different conditions. Diversification is not about maximizing returns. It is about survival and consistency. It ensures no single event derails your entire plan. That is why this framework includes 5 distinct types. Mistake 5, starting too late. This is the most unforgiving one. You cannot build a durable retirement portfolio in 5 years. It takes time for dividends to grow, mortgages to be paid down, properties to appreciate, and index funds to compound. If you are in your 20s or 30s, time is your greatest advantage. Use it. In your 40s, act decisively and consistently. In your 50s, the margin for error is thin. Focus, discipline, urgency. In your 60s, without these assets, the reality is harsh. You may need to work longer or adjust expectations significantly. There is no shortcut that replaces decades of compounding. That is arithmetic, not pessimism. A practical roadmap by age. In your 30s, focus on building the index fund and starting dividend stocks. Time does most of the work. In your 40s, add income-producing real estate, accelerate dividends, pay down the mortgage aggressively, begin inflation protection. In your 50s, complete the 5 assets consistently. If you build these 5 assets steadily, retirement becomes manageable. Not extravagant, but secure, calm, predictable, free from constant financial anxiety. So here is the challenge. After hearing this, do not just nod along. Take action today. 1 action: buy your first dividend-paying stock, invest in a low-cost index fund, research rental properties or REITs, purchase inflation-protected securities, make an extra mortgage payment. 1 step today, another next week, another next month. That is how real portfolios are built, not in dramatic moves, but through steady, repeated action. I have seen hundreds of retirements over a very long life. The pattern is always the same. The good retirements belong to people who built the right assets. The bad ones belong to those who did not. The difference is preparation. By the time retirement arrives, the outcome is usually already decided, not because of luck, not because of intelligence, but because of preparation or the lack of it. I have watched this play out repeatedly over decades. Some enter retirement calm, confident, and in control. Others enter anxious, constrained, and worried about every dollar. The difference is rarely income alone. It is whether they built the right assets early enough and stayed disciplined long enough. Retirement does not reward last-minute effort. It rewards long-term structure. This is why I have been so insistent on these 5 assets. They are not trendy, they are not exciting, they do not promise overnight results, but together they form a system that works, one that absorbs shocks, adjusts to inflation, and supports you for decades. When markets crash, diversified dividend stocks continue paying. When inflation rises, rental income and inflation-protected securities adjust. When you live longer than expected, long-term growth assets keep compounding. When expenses spike, low housing costs give you room to breathe. Each asset solves a different problem. Together they remove the need to guess. And that is the real goal of retirement planning, eliminating uncertainty. Most people do not fail because they make terrible decisions. They fail because they delay good ones. They assume they will figure it out later. They assume there will be time. They assume something external will save them. Time is the one thing retirement planning does not forgive. Compounding only works when you give it years, sometimes decades. Dividend income only becomes powerful after it has been growing for a long time. Real estate only becomes meaningful after mortgages are paid down and rents rise. Index funds only reveal their full strength when left untouched through multiple cycles. You cannot replicate that process at the end. That is why action matters more than information. You do not need to build everything at once. You do not need to be perfect. You do not need a complex plan. You need to start 1 account, 1 asset, 1 deliberate decision, then another, week after week, year after year. This is how people quietly succeed at retirement while others wonder why it feels so hard. If you are younger, your advantage is time. Use it while it is available. If you are mid-career, your advantage is earning power directed intentionally. If you are nearing retirement, your advantage is clarity. Act decisively. What you cannot afford is inaction. Retirement is not an event. It is a phase of life that arrives whether you are ready or not. And when it arrives, it does not care about intentions. It only reflects preparation. I have watched people assume Social Security would carry them. It did not. I have watched people rely entirely on market growth. One downturn changed everything. I have watched people underestimate inflation. It quietly eroded their lifestyle year after year. And I have watched others quietly, methodically build these exact assets and retire without fear, not wealthy beyond measure, not extravagant, but secure, independent, at peace. That is what these 5 assets provide. Not luxury, not shortcuts, but dignity, stability, and control. So let me leave you with this final challenge. Do not wait for the right time. Do not wait for certainty. Do not wait until everything feels comfortable. Pick 1 asset today and act. Open the account, make the purchase, pay down the balance, begin the process, then repeat, Your future retired self is not asking for perfection. They are asking for effort applied early and consistently. Build the assets. Stay disciplined. And when retirement arrives, meet it with confidence instead of fear. That is the path. Follow it. And retirement can become one of the most stable, rewarding phases of your life rather than one of the most stressful.